Every investor, whether you're a seasoned pro managing millions or just getting started, you run into the exact same question. You see a great return, but how can you really know if it was because of a brilliant strategy or just a crazy, reckless gamble that happened to pay off? Let's get into it because honestly, telling the difference is everything.
Just think about it for a second. Let's say you see a fund that posted a 20% return. I mean, that sounds amazing, right? But what if another fund also made 20%, but their investors had half the stomach-churning ups and downs along the way? All of a sudden, those two 20% returns don't look quite so equal anymore, do they? Well, this is the exact problem that a really powerful little tool was built to solve.
And that tool is the Sharpe Ratio. This thing goes all the way back to 1966, developed by the Nobel laureate William F. Sharpe. Over the years, it's pretty much become the financial world's standard scorecard. It's the go-to metric for grading an investment, not just on how much it made, but on how much risk it took to make it.
Okay, so this is the formula right here. And I know at first glance it might look a little intimidating, but I promise, the idea behind it is super simple. Just think of it like a basic fraction. You've got the reward you earned on top, and that's divided by the risk you took on the bottom. So let's break down what each of those pieces really means.
So that top part of the fraction, the numerator, that's our reward. But here's the key. It's not just your total return. It's what we call your excess return. It's the profit you made above and beyond what you could have gotten from something totally safe, like a US Treasury bill. In other words, it's the bonus you get for choosing a little adventure instead of just playing it safe. All right, now for the bottom of our fraction, the denominator. This is where we measure the risk. Now, the fancy term for it is standard deviation, but a much better way to think of it is just volatility. How bumpy was the ride to get that return? A really high standard deviation means it was a white-knuckle ride, with huge swings up and down. A low one means it was a much calmer, smoother journey. The Sharpe ratio wants to know exactly how much turbulence you had to fly through. Okay, so you plug in the numbers, you do the math, and out pops a result. But what does that number actually mean? How do the pros on Wall Street look at this score and decide if an investment is good, bad, or just meh? Well, this table is basically the industry's cheat sheet. Anything below 0 is just plain poor. You literally would have been better off just sticking your money in a safe treasury bill. Anything less than 1 is usually seen as suboptimal. Yeah, you made money, but you weren't really paid enough for the bumps you had to endure. That sweet spot, what a lot of really high-quality funds aim for, is somewhere between 1 and 2. Once you start getting above 2, you're looking at some seriously strong performance. And above 3, that's exceptional. So exceptional, actually, that it usually makes analysts want to pop the hood and see what's really going on. Theory is one thing, but the real test is always in the real world, right? So let's put this scorecard to work and see how some different types of investments actually compare when you look at them through this risk-adjusted lens. Now, this chart is fascinating because it really shows you the trade-offs. The S&P 500, which is basically a proxy for the entire stock market, often has a Sharpe ratio just shy of 1. But then you look over at private real estate, and it's clocking in around 1.3. On the surface, it looks like a way better risk-adjusted return. But there's a catch. Private assets like real estate, they aren't priced every single day like stocks are. They're valued way less often, which artificially smooths out the data and makes the volatility seem lower than it probably is. This is a perfect example of why you can never just take the number at face value without knowing the context. And this is where we really level up our understanding. Because as powerful as the Sharpe ratio is, it's not perfect. It has some really critical blind spots, and every serious investor absolutely needs to know what they are. Okay, this right here is the single biggest flaw, and it's crucial to get this. The Sharpe ratio is completely blind to the direction of the volatility. It treats a sudden massive gain, the kind of upside surprise we all dream of, the exact same way it treats a sudden massive loss. Both those events increase that bumpiness factor, that standard deviation, and will actually punish the investment by lowering its Sharpe ratio. Just think about that for a second. The formula literally penalizes an investment for having huge positive surprises. And this isn't just a theoretical problem. It can have catastrophic consequences. The most famous cautionary tale here is the hedge fund long-term capital management. I mean, they had a phenomenal Sharpe ratio, something like 4.35, seemingly the best in the business. But their whole strategy was based on making tiny, consistent gains while taking on this hidden massive risk of a total wipeout. The ratio captured that smooth, steady ride, but it completely missed the giant cliff at the end of the road. It's because of limitations like these that professionals never, ever rely on the Sharpe ratio alone. They see it as the starting point of their analysis, not the final word. Think of it this way. It's the first tool you pull out of the toolbox, but you're going to need a whole lot more to get the full picture. And that toolkit includes a few key specialists. For example, the Sortino ratio. It's basically the fix for that big flaw we just talked about. It only cares about the bad volatility, the downside risk. Then you have the Trainer ratio, which is great for big, diversified portfolios because it measures performance against the risk of the overall market. And for those of us who are most worried about the absolute worst-case scenario, the Kalmar ratio hones in on the single biggest drop an investment has ever experienced. Each one of these tools gives you a different and really crucial piece of the puzzle.
So we've walked through how it works, how to read it, and where its biggest flaws are. What's the final takeaway? When all is said and done, what's the true purpose of this powerful little ratio?
You know, its real power isn't in giving you a simple yes or no answer. Its true genius is that it forces you to ask the single most important question in all of investing. Given the journey, given all the volatility, and maybe a few sleepless nights, was the return really worth the risk? And learning how to answer that question, well, that's what separates good investors from great ones.